My name is Todd Rooker. Welcome to Cap Expert. We are going to be talking about how to recover, essentially hangover from the real estate disaster that we've all gone through. I have been involved in an industry where I help people recover from these things for over 20 years. By the way, if there's anyone you know of who might be interested in this, friends, family, clients, they can check it out on the website, and I believe it'll be archived for them to watch it again. My business basically has revolved around helping people who are in financially challenged positions. I've been doing it for a long time and don't really have a whole lot of other people who do what I do. My typical client is a person who might come to me and say, look, Todd, I've never missed a payment in my life. In fact, I never thought I would, but I feel as though I'm exhausting all of my resources trying to make my payments on time. And that really often means that they're taking loans from retirement accounts, taking cash advances from credit cards, even borrowing money from family and friends. And they'll tell me that. And then go on to say that basically all they feel as though they're doing is delaying the inevitable and throwing good money after bad. So the questions are, how do they deal with this? How do they minimize the damage and get back on their feet on the other side? And obviously, this little webinar and class that this is giving you some insight into is to cover and handle those exact things and then to come out of it on the other side. That's really my business. I have to know what the attorney, the financial advisor, mortgage broker, credit specialist, and real estate agent all rolled into one know to give people good advice, and that's what this will be for you. The ability to give people good and accurate information as opposed to the contrast, which could be very devastating down the road. So here we go. Real estate hangover. Time to wake up, huh? Sounds great. Addressing outstanding mortgage debt. So this is an issue where you have to be conscious of future financing and how to rebuild. So rebuilding credit for future financing means that you have to set goals to build stability. When it comes to qualifying for financing in the future, it'll be more than just credit. It'll be about your financial standing. And remember that even if you have an 800 credit score, you may still not qualify for a loan. So a lot of people will come through things like short sales and foreclosures and bankruptcies and judgments and believe that if they get 2 or 3 years down the road, that means now they can qualify because there's timelines associated with that. The problem, of course, is that there's strict underwriting guidelines that regardless of your credit score or the time that has elapsed, you may still not qualify for financing. And these are the things that you need to know about in advance. So I'm always interested in setting goals to build net worth, which really means stability since you'll not have credit for a period of time while you're going through the rebuilding process. The other thing you have to be conscious of is not going into a relapse situation where you might go back to the same type of compromised position. Remember, most of the people who go through this probably have never missed a payment and have been solid and stable their whole lives and have never perceived money management as being a problem. Of course, the issue is that they've never been without credit. They've always had available credit to work with. So when those people come through a crisis like that, they believe that once that crisis, the foreclosure or the short sale or what have you, has gone by, now they can relax and let things go back to normal, not realizing that they have no backup plan in the form of available credit, which means they have to manage their money in a way that they never have before, and they don't understand this at the onset. They all believe that the money management was never the problem, and as soon as this has subsided, they can relax and go back to normal, which of course, now they're right back in the storm all over again. So that's something you really have to let them know. The effects of debt on real estate purchases. A lot of people have gone through a process where they may have had a short sale or a foreclosure, and there's outstanding debt that is still hanging around. So when that takes place, maybe we're talking about a lien release, wherein a short sale could take place or even a foreclosure, and the lien was released against the property. The property has gone through foreclosure or short sale or deed in lieu or what have you, but they don't realize that, yes, the lien was released against the property. Yes, the property's now gone back to the bank or has been sold to a new consumer. However, there's still the debt, the obligation to repay it, and although nobody's pursuing it, don't for a moment think that that debt isn't still out there. So when you go to consider refinancing in the future, you have to be cognizant of the fact that this has got to be addressed and handled. Otherwise, you're not getting financing. And it doesn't matter what your credit score is, and it doesn't matter how much time has elapsed. No one's going to give you a loan when you've got a $50,000 second mortgage that's unpaid and in default hanging out there. So you've got to take care of those things. Now, there's 3 ways to deal with debt, or at least my little spiel is always on debt. You have 3 straightforward options. One is to pay in full, which means, hey, pay all the money. If you've got all the money to pay, if you can sell an asset, if you have resources that you can tap into, hunting land, take a loan from a retirement account, or even a distribution to bring closure to the debt. Or, of course, there's always the pay the money in full as you go. But when you think about that, remember that paying the money long term is oftentimes going to take years and years and years, and you can't miss any payments along the way. So you have to be conscious of the fact that if I am going to enter into a payment plan, which sometimes is a decision to make no decision at all, if I'm going to do that, then I have to be conscious that I can sustain this payment long term, because if you look at the amount of cash flow you have available to pay down this debt, it's probably going to take years to do it, and you have to confront that straight up. So when you do that, think about, is this doable or is this not? Avoid relapse, don't relax, and go back to old habits. That's kind of what I talked about a moment ago. Keep your foot on the spending brake. That means that even though things have gotten better, you want to continue to maintain a controlled spending plan to be able to build net worth. A lot of people are more focused on lifestyle than they are in building net worth, and that's one of the main things that I have to deal with, is to focus on building stability and then later net worth, because many people measure their financial success in lifestyle as opposed to net worth. So we're talking about building net worth, building stability for future financing, and putting yourself in a strong position so that you're never here again, obviously. Lifestyle is not as important as net worth. That's a decision every individual has to make. It's ironic when you ask a person how they're doing financially, they will often cite things like, well, we took a vacation, and of course that's assuming you actually would ask someone that, and they'll tell you about the car they bought, the addition they put on the house, none of which necessarily are going to increase or improve net worth. So the point is, most people, when they think about financial success, measure themselves instead of net worth, assets minus liabilities, rather in lifestyle. You have to change that perception, and you have to draw the line and say, how much lifestyle am I willing to give up to build stability and net worth? And once you do, then you help them hold that line. Have a second signer to draw on accounts for accountability. What that means is, when I do budgeting, I would always like to have the emergency fund as an account set up, whereas if you're married, you and your spouse both have to sign to touch that dollar amount, or that amount that's in that account. The reason is simple. If that's the stability for the family, you want someone to help you vet that decision, because frankly, we can all talk ourselves into just about anything we want to hear. And the problem with that is that now you don't have that emergency fallback plan. So it's very important that you have someone to vet those decisions with, to ensure that you're not robbing your own financial stability, the stability that you've worked so hard to create in the form of an emergency account. Share your goals with someone and check with them. This is really accountability. One of the most valuable things if a person is trying to lose weight or go through any type of a process such as that, accountability, having somebody that you answer to, someone that you know that when you tell them what you're doing, they're either going to agree or not agree, and they're going to tell you what they really think. That honesty and that accountability really is essential when it comes to building financial stability, and everyone should have it. That's why I know that, I can do budgeting for people, and sure, for a fraction of what I charge, they could, do a free budget on the internet. Okay, fair enough. The problem is there's no accountability. So when they fall down, they don't feel that bad because nobody's making them feel that way. And obviously most people don't want to be made to feel that way, which is frankly why they fail. So we need to have some type of accountability and some type of a system in place to ensure that you stick to those goals. You must have a mindset and a great desire for financial stability. You have to actually want this. That's why I'm never about being thrifty. I just say, do you want to build stability in your life? Not, grandiose net worth, and I'm going to talk about that a bit here. But the reality is most people can buy into stability, and the truth is this something that you really want? Because if it isn't something that you're interested in, if it really isn't that important to you, then not me nor anyone else is going to talk you into it. So you have to have that desire yourself to actually want that stability. You've got to build long-term stability through solid real estate purchases. Well, real estate's one of the best ways there is to build net worth. And so if you're going to put money into something, obviously you would want it to be an asset that appreciates, and real estate gives you leverage in a way that pretty much no other investment asset might. That said, again, it has to be something that you're interested in. And when buying real estate, I don't believe in the short-term approach. I believe in the buy and hold strategy, that you're in this and you're going to build long-term stability and net worth. And so the other issue that I've kind of touched on here is saving for the sake of saving, which really is emergency funding. It's the biggest challenge I have and one of the toughest sells, which is saving not to buy anything. For a lot of people, that really doesn't make sense. I mean, if they're going to put money into an emergency account, and imagine that for most people, that's going to be at least 3 to 6 months of their total expenses, which means if we're talking about $5,000 a month in expenses, we're talking about $15,000 to $30,000 in an emergency account. We're not talking about investment accounts, your retirement account. I mean, this is your first line of defense. Well, for most people, they put that much money away, they're immediately thinking about all the things that they can buy with it, because that money's sitting there and they just can't imagine that they would work this hard to save, not to buy anything with. You've obviously got to change that mindset, and you have to be focused on stability and place great value on that. How to make major purchases using a budget. One of the most important things about having a budget and a controlled spending plan is that it is used as a tool to make decisions from a position of financial accuracy. So before I make any purchases, I plug that information into my budget and I determine if this is something that I can do, all things considered. Now, when I say all things considered, remember, when it comes to real estate, just because you have $1,800 per month in rent that you've been able to pay, by no means says that you can afford $1,800 per month in a mortgage payment. Remember that if you're moving, the driving proximity may change, the utility costs will change, the home upkeep and maintenance will change. All of these things need to be factored in, and when you put all of that in there, you may find out that based on all the other expenditures that you currently have, you can only afford $1,000 per month. Problem is, most people never do it that way. So if they've been through a financial storm, then obviously you want to ensure that they're never going to do this again, so they've got to do it differently. And just because you can qualify for a mortgage does not mean that you can afford to make the payment. You need to be conscious of those things. So, buying a car with cash. I have a process that I use to purchase automobiles. And one of the most important things about buying a car for me is that I never purchase new cars, and I'm very strategic about it. But the point that I would make about buying automobiles is that if you're going to make a payment and you're going to set that payment up for 4 or 5 years, remember that when it's done, when you finish making the payments on a car, you continue to pay yourself. So imagine if you set up a car payment for 4 or 5 years and then you keep the car for 4 or 5 more years thereafter. At the end of that period of time, you have saved up all the money because the payments that you made before, remember, included interest. This time around, you're paying yourself the interest back. All the payment is going to you, plus the car is still going to be worth something as an asset, which means from here on out, you're going to trade up, trade up, trade up, and the payment that you make to yourself will never change for the rest of your life. That is a formula that works and helps you build stability and net worth, and it gives you a predictable payment every month so that you can take the extra money and pay yourself and build net worth, or, of course, stability. So, focus on money management and future financing. It's the number one thing, and again, I'll just simply say it doesn't even occur to most people that that's what they should be focusing on. Understand how difficult budgeting and money management is. Part of the challenge with money management is that most people believe that anybody with a calculator can do a budget. As a matter of fact, Mr. Rooker, if you're telling me or even insinuating that I need help with this, I think I'm offended by the very fact that you even bring it up. I know they feel that way. They're wrong, but that's how they feel. And the challenge with that is that you have to recognize it's not the mathematics that make money management challenging. It's that we are human beings, and the psychology and the ability for us to essentially delude ourselves into anything we want to hear means we can manipulate the numbers to see what we want to see. That's what makes it hard. So while the concepts are simple, it is by no means easy. And the reality is that most people who will not tell you this struggle with day-by-day money management more than just about anything else. And that doesn't matter if they've got a financial planning background or if they've managed large sums of money at work, because those people tend to be even better at manipulating the numbers to see what they want to see. So day-by-day money management is something that is very difficult, and it's okay to recognize that you're having challenges with it. It is okay, because it is challenging, and I've been helping people for over 20 years deal with this. Continue to work as hard after paying off the debt. So, hey, if you're going to pay a creditor to pay all the money and pay them off, remember something. Are you willing to work that hard? Are you willing to take the part-time job? Are you willing to take the overtime? Because many people will do those things in an effort to pay the debt back, and then once they've paid it off, then they stop working on the side job. They stop taking the overtime because now they can relax. Are you willing to continue to work that hard to pay yourself? That's the question. And then if you are, you divert those dollars towards doing that very thing. So, we're done. So if there's any questions, I can answer those questions now. They're going to show up on the screen. I should tell you, as rolling through this, that when people have debt, they generally have three options to deal with the debt. And you've got to take the debt and you have to focus on that, because you've got to tie all those debts up. Once you've got that taken care of, then you can move on to rebuilding credit and finances. So you have to take care of that. And there are certain ways to deal with debt. If I have debt, I have three options, basically. One, pay all the money. I talked about that a little bit. That means either a payment plan that you believe you can sustain because you've got a budget and you're aware that you actually can sustain it, or that means that you're going to take an asset, sell it, and then take care of the debt and be done. That's the best way. It's the only one that's going to preserve your credit. A second option is going to be to settle the debt for a percentage of what is owed. Now, that means that basically you've come to the conclusion that you can't afford to make the payments. And remember something about making payments. It's really easy to believe that you can do this, but when you take a look at the amount of cash flow it'll take to bring closure to a debt, say a second mortgage, remember, you may be talking about years. So it's one thing to say it, it's another thing to do it. And I'm not insinuating that a person shouldn't pay their debt and pay their bills. What I am saying is they need to look at it objectively. And if option one, pay all the money, isn't going to work, then you're relegated to the next two options. The next option is to settle the debt for a percentage of what is owed. But this is not a payment plan. This is generally a lump sum that you can take that debt and do away with it and bring closure to it. So if it's going to be a lump sum, what are the percentages that you should assume it's going to take to do this? Well, if you're talking about mortgage debt, generally you're talking about 10 to 30 cents on the dollar. If you're talking about credit card debt, probably 40 cents on the dollar is a factor you should use. So that's the two of the three. What's the last one? File bankruptcy and discharge the debt, which actually is a means to bring closure to that debt. I've been dealing with this since the farm crisis of the mid-'80s, and I've learned how to go and do battle with financial institutions, and I can tell you that really, no matter how you look at it, those are the options that a person has. I see I have a question here. How can I be sure my short sale is off my record? Well, you first of all have to look through the paperwork. If you went through a short sale, you were given documents from the lender that told you if you were getting a satisfaction of debt. That means the debt was settled, and there's definitive terminology that you're looking for. Settled, discharged, meaning the debt is discharged. But when you have a lien release simply releases the lien against the property. Your short sale can go through with a lien release if there's a second mortgage, but that doesn't mean you're off the hook. The other thing you have to recognize is that depending on your state, some states have non-recourse, wherein they cannot pursue the debtor for the deficient debt. And deficient debt is the difference between the outstanding mortgage amount and what, in this case, a person might have sold their home for in a short sale and then less the cost what went to the bank as a net after they paid all the real estate fees. That difference, known as deficiency, in some states may be non-recourse. In other states, even if you only have a first mortgage, they can pursue that debt. And that really comes down to, is this a judicial foreclosure state? Is it a non-judicial foreclosure state? Is it both? Are we talking about deed of trust or trust indenture in different states as opposed to bona fide mortgages? All of these things come into play. So when you ask the question, is it off my record? You're going to look at the documentation to determine if you actually got a full and final satisfaction of the debt. Not simply a release of lien from the real estate, but rather are you personally still on the hook for the debt? And it's a dangerous proposition. So I'll go on and talk more about how to handle debt. So we did say that option 2 was that you could settle the debt for a percentage. Many times people land on option 2. They may not have all the money to pay all the money down. However, they also don't want to file bankruptcy. The problem, of course, is that they actually have to have the money to settle the debt. And remember something, if it costs a few $1,000s to file bankruptcy and you've got $100,000 worth of debt, if you can settle it at 40 cents on the dollar, that's $40,000. It sounds a lot better than $100,000, but it's meaningless if you don't have the money to be able to settle it. And remember, whether you're 50 feet underwater or 100 feet underwater, you're drowning in either case. So be aware that in some cases, bankruptcy may be the best tool you have to bring closure to the debt so that you can move on with your life. And remember, anything related to credit always can be overcome in the future. So, is it okay to buy subject or should you use regular? Okay, I'm not sure exactly what that means. I suspect that it maybe means subject or should you use regular financing, are we talking about? I'm not actually sure, Frank. I see another one. What is the Minnesota rule? The Minnesota rule, as it relates to our debt, is that our banks can foreclose in both ways. They can either do judicial or non-judicial. So in the state of Minnesota, if a bank chooses to foreclose in a judicial process, well, then they can pursue the debt, the deficiency debt, on even a first mortgage. If it's a non-judicial foreclosure and a share sale takes place, once the share sale takes place, the lender who actually pursued foreclosure in a non-judicial process must comply with the statute, which means that if they foreclose in that way, then that debt becomes non-recourse. Now, that's only related to the lender who brings the foreclosure action in that way, which generally will be the first mortgage. So what that means is if you have a junior lien, a second or third mortgage, a home equity line of credit, they can still pursue their debt. And generally they will in the future. Let's see here. How can I be sure my short sale is off my record? Well, short sales don't show up on a credit report so when you say record, we're talking about transparency. Let me just click on it here and see. It's okay. So when you think about that, when you think about a short sale being off your record, you're talking about something that will show up on a credit report, and it won't say short sale. There's no such thing as short sale on a credit report. What it will say is settled for less than owed or settled for less than full balance. When you take care of a short sale, it doesn't come off of your credit report. It will stay on there, generally for 7 years from the most recent activity date. That's how long it'll stay on your credit report. So when a mortgage underwriter looks at your credit report in the future, there's different underwriting guidelines related to conventional financing and FHA financing. And they're going to look at those underwriting guidelines, which may hold you back from financing for as little as 18 months and sometimes even less, depending on if you didn't miss any payments leading up to the short sale or not. And at the outside for an FHA loan, 3 years. When it comes to conventional financing, you're going to be looking at probably 5 to 7 years from the closure of that. So taking care of a short sale, getting it completed and closed, by no means takes it off of your record. As a matter of fact, the date that the short sale closes, it'll stay on your credit report for the next 7 years and will continue to affect your credit score for the length of time that it's on there, and will continue to affect the underwriting guidelines, meaning your ability to secure financing in the future based on that date and what the underwriting guidelines are, whether they're 18 months or 5 years, something of that nature. Let's see here. Is it smart smart move to take equity line from home to pay off, let's see here. Is it smart to move to take equity line from home to pay off credit card, $5K, just to clear it and get over with it, or just continue paying slowly? I would never take equity from a home to pay down unsecured debt. Here's why. Depending on your state, most states have the ability to exempt mortgage equity, your home, your primary homestead's equity. In our state of Minnesota, it's $400,000 of equity that you can carry as exempt all the way through bankruptcy. So remember that you could file bankruptcy, you could have $400,000 of equity in your home, and you could discharge all of your credit card debt. Exemptions are at the heart of asset protection. So if I'm going to put money anywhere to protect it, even all the way to bankruptcy, it's going to be in my home mortgage. So consequently, my two big exemptions are retirement account and home equity. So obviously, the reality is those are the places that I'd never touch if I have credit challenges. I would rather pay it off over time. And if things do go bad and I'm unable to, at least I can preserve all that equity in my home and my retirement account, even if, God forbid, I should wind up having to file bankruptcy. So that's the way I would look at that, and that's the answer to that. I would pay it off over time. I would never use my home equity to do that with. See if I can scroll down some more. How would personal bankruptcy affect credit? Well, ironically, personal bankruptcy is not going to destroy your credit. It's really about the late payment history leading up to the filing of a bankruptcy. If you have, a lot of people tell you your credit score is going to go down 300 points if you file bankruptcy. It's not true. The reality is that if you've never missed a payment and you understand where you are financially and you've been using resources like a retirement account to subsidize making your payments on time, which is why you've not missed a payment, but you qualify for bankruptcy, well then consequently you could file bankruptcy and your credit score may only see about a 100-point hit, and that means that within 2 years, based on FHA guidelines, you could qualify for the best financing that exists within 2 years of the discharge date of a bankruptcy, and you could have your credit score back in the 700 range. I have clients who have sometimes debts that are in the hundreds of millions of dollars, and yet within 2 to 3 years with proper strategic credit management, they can have their credit score back in the 700 range in that time or less, 2 to 3 years. So you lock yourself down and you prepare for the storm, do the financing you need to do, and then get your bankruptcy taken care of and move on and rebuild your life. Let's see what else we have for questions here. Why would people use option 1, paying entirely, if they, let's see what else we got here. Option 1, paying entirely, if they have option 2, pay less, a percentage. Well, that's obvious because it's the right thing to do because they owe the money. I take it that option 2 has more severe consequences as remaining on your credit, and that option 1 clears you completely. Well, it's not that option 1 clears you completely, it's that you've never missed a payment. Remember that, if a person's upside down on a piece of real estate and the value that they put on their credit is significant because of the job, meaning it's more than just credit. It may be that I have a high-level security clearance or other things like that where I may lose my career path and go no further in advancement in my career because of this. If that person is upside down in their real estate and they want to avoid credit issues, pay the bill, and when you go to closing, write a check for the deficiency. And then that means that's how much your credit is worth to you. Don't forget that. So that's why a person would do option 1. And of course, the other reason is it is, at the end of the day, the right thing to do. And if a person has the money to pay, well, then they should pay. But if they legitimately, objectively don't, then they have to consider options that you are correct. Will have greater implications to their credit, will take time to recover, and obviously, to settle a debt, you're going to have to miss payments. So you don't just go 30 days delinquent, call up your creditor and say, hey, I'll give you 30 cents on the dollar. It's not going to happen. You have to be delinquent enough that your credit file passes through the different departments within that financial institution until it gets to the point where they realize that there's a high probability that you'll file bankruptcy, and consequently they are now willing to settle. Remember, general collections will set you up simply on payment plans and lower your interest rate. You'll have to become delinquent enough before they begin to send out notices saying they're willing to settle for X% on the dollar. When that happens, you know you're in the sweet spot, but by that time, do not forget that your credit has been trashed. So you're going to have to overcome that. But remember, anything related to credit can be overcome. Don't forget that. 2 has more severe consequences remaining on your credit, then option 1 clears you completely. Sure, you haven't missed a single payment. So that's the answer to that one. I know we're running at the end of our time here. Hopefully this has provided you with some insight. The main thing you need to recognize is whatever issues you have hanging out there, you need to tie those up with a bow. Whether that means pay the money, whether that means settle for a percentage or file bankruptcy, you bring closure to it. Then you focus on the underwriting guidelines in the future. You begin to rebuild your credit and position yourself for future financing. And even if you don't think you want financing, believe me, 2 or 3 years from now, if you decide you do, you won't want to be told it's going to take 2 or 3 more years to position yourself for that future financing. So do be aware of that. You always want to position yourself to be in a good position. Hopefully this has given you everything you need. Remember that if anybody out there is interested, we teach the class, the Real Estate Hangover here at Kaplan. If you want to watch this again, or you know of somebody who does, they can go to RealXperts and they can watch the archived video again. Thank you so much.